Welcome back, ladies and gentlemen. Thank you all for joining me today. We're going to be taking a look at the, legendary investor Howard Marks, who just put out a memo. He puts out memos every once in a while. It's really important, like if you want to read these, to make sure to kind of sign up for the different newsletters that they have or different alerts that they may have. Or if you have someone like me, you find someone on Twitter who puts out these letters and puts out like a summary of everything. That's also great as well. But I'm going to be going through the letter myself today and kind of touch on what I thought was really important and talk on some things I thought was really important too, because really what this is all about is he called this letter and titled it Sea Change, and he's referring to a lot of important things that I think investors should pay attention to. Now, if you're into this kind of stuff, if you like value investing, you like big super investors, make sure to hit like and subscribe down below. It's really important to help out the channel. Thank you all for the 89 subscribers here on the channel. Hope to keep growing. Hope to see you on another video. With that being said, let's dive right into it. Now, taking a look at the letter up here on the screen, I'm just going to be kind of talking on this and explaining what I see and what I think is important. So the thing is that he defines a sea change as a complete transformation, a radical change of direction in attitude, goals, etc. So the thing is, and what he's pointing at today is that he only remembers two real sea changes, so two real radical directions and changes. And he continues to go on from that, and he thinks what we may see is the third one. So the big thing is that he opens up with, as I've recounted many times in my memos, when I joined the investment management industry, it was 1969. Many banks, like the one I worked at the time, focused their equity portfolios on the Nifty 50. But if you bought the Nifty 50, and this is me jumping, but if you bought the Nifty 50 when I started the bank and held them until 1974, you were sitting on losses of 90% from owning the best pieces of companies in America. Perceived quality, it turned out, wasn't synonymous with safety or with successful investment. So really here, he's kind of opening it with kind of setting the tone of what he is seeing and understanding and trying to make people understand, like, this is what is actually happening, and trying to get people to understand, like, this is also kind of like where people started, and we haven't changed that much, because history doesn't repeat itself, but it sure does rhyme. So continuing on though, the big highlighted, or I guess the piece that he bolded, in other words, whereas prudent bond investors investing had previously consisted of buying only presumably safe investment grade bonds, investment managers could now prudently buy bonds of almost any quality as long as they were adequately compensated for the attendant risk. And the U.S. high-yield bonds universe amounted to about $2 billion when I first got involved, and it stands today at $1.2 trillion. This clearly represented a major change in direction for the business of investing, but that's not the end of it. Prior to the inception of high-yield bonds, companies could only acquire larger companies if they had the cash, basically. So you had to be able to either have the cash or acquire the cash somehow, and now you can do leverage buyouts and basically buy out entire companies using debt. So going on to the highlighted pieces and what I really want to dive into. So he said, however, the most important aspect of this change didn't relate to high yield bonds or to private equity, but rather to the adoption of a new investor mentality. Now, risk wasn't necessarily avoided, but rather considered relative to return and hopefully borne intelligently. This new risk to return mindset was critical in the development of many new types of investment, such as distressed debt, mortgage-backed securities, structured credit, and private lending. It's no exaggeration to say today's investment world bears no resemblance to that of 50 years ago. Young people joining the industry today would likely be shocked to learn back then the investors didn't think in risk to return terms. Now that's all we do, ergo a sea change. So this is what he's really referring to, is like complete changes in people's mentality and what that actually means. Now he goes on to say, at roughly the same time big changes were underway in the macroeconomic world, I think it's all started with the OPEC oil embargo of 1973 to 74, which caused the price of a barrel of oil to jump roughly $24 to almost $65 in less than a year. This spike raised the cost of many goods and ignited rapid inflation because the U.S. private sector in the 1970s was much more unionized than it is now, and many collective bargaining agreements contain automatic cost of living adjustments. Rising inflation triggered wage increases, which exacerbated inflation and led to yet more wage increases. This seemingly unstoppable upward spiral kindled strong inflationary expectations, which in many cases became self-fulfilling, as is their nature. The year-over-year increase in CPI, which was 3.2% in 1972, rose to 11% by 1974, receded to the range of 6 to 9% for the 4 years, and then rebounded back to 11.4% in 1979 and 13% in 1980. There was great despair as no relief was forthcoming from inflation-fighting tools ranging from whip inflation now buttons to price controls to a federal funds rate that reached 13% in 1974. It took appointment of Paul Volcker as Fed chairman in 1979 and the determination he showed in raising the Fed fund rate to 20% in 1980 to get inflation under control and extinguish inflationary psychology. As a result, inflation was back down to 3.2% by the end of 1983. So he's really touching on like Paul Volcker and how it took someone else to actually come in and make a huge change to inflation, and he's kind of opening up with this to be able to talk about what's happening today and sort of explain that. So Volcker's success in bringing inflation under control allowed the Fed to reduce the Fed fund rate to high single digits and kept it there for most of the rest of the 1980s before dropping into the mid-single digits in 1990s. His action ushered in a declining interest rate environment that prevailed for 4 decades. I consider this a second sea change that I've seen in my career. And he kind of touches on this and why it's so important and what interest rates do. But a lot of what he touches on is that a lot of the bull market that we have seen in the last couple of decades, especially over the last decade into the decade before, what we have seen is this huge bull market run, and a lot of that happened because we were in a low interest rate environment. Because what happens is people have to shift to more and more risky assets because the original safe assets like T-bonds, T-bills, high-yielding bonds, AAA rated bonds don't give that much of a yield anymore. So moving on though, he said, what are the factors that gave rise to investor success over the last 40 years? We saw major contributions from the economic growth, preeminence of the US, the incredible performance of our greatest companies, gains in technology, productivity, and management techniques, and then D, benefits of globalization. However, I'd be surprised if 40 years of declining interest rates didn't play the greatest role of all. Now, here he goes on what the effects are of the declining interest rates, and he kind of touches on how, it has really dropped quite a bit. But here are the effects of the declining interest rates according to him. They accelerate the growth of the economy by making it cheaper for consumers to buy on credit, for companies to invest in facilities, equipment, and inventory. They provided subsidy to borrowers. They reduce businesses' cost of capital and thus increasing profitability. They increase the fair value of assets. And again, the theoretical value of an asset is defined as the discounted present value of its future cash flows. The lower the discount rate, the higher the present value. Thus, as interest rates fall, valuation parameters such as PE and enterprise rise, and the cap rates on real estate decline. They reduce the prospective returns investors demand from investments they're considering, thereby increasing the prices that they'll pay. This can be seen most directly in the bond market. Everyone knows it's rates up, prices, or rates down, prices up, or rates up, prices down, but it works throughout the investment world. By lifting asset prices, they create a wealth effect that makes people feel richer, thus more willing to spend. Finally, by simultaneously increasing asset values and reducing borrowing costs, they produce a bonanza for those who are buying using leverage. So he talks about, let's think about this for a little bit. Think about a buyer who employs leverage in declining rate environment. He analyzes a company, concludes that he can make 10% a year on it, and decides to buy it. He then asks the head of capital markets how much it would cost to borrow 75% of that money. When he's told it's 8%, it's full speed ahead. Earning 10% on 3/4 of the capital that's borrowed at 8% would lever up the return on another 1/4 to 16%. Banks compete to make that loan, and the result is an interest rate of 7% instead of 8%, making the investment even more profitable, a 19% levered return. The interest cost on his floating rate debt declines over time, and when his fixed rate debt matures, he finds he can roll it over at 5%. Now the deal is a home run, a 25% levered return, all else being equal. So kind of going back up to what he's talking about here, so this wealth effect is what people have been feeling in the United States all throughout 2020, 2021, and you can really see it take effect as things kind of let up COVID-wise. And so, he talks about the leverage that people are using and what this actually means and how the declining interest rates let people kind of, oh, I can buy that because the interest rates are really low. The car loan, oh, I can buy even bigger car or a more expensive car because the car loan, the payments, 10 years ago, 20 years ago, I could only get a $10,000 car, but now I can get a $20,000 car. Same payments, same, time to maturity. That's what you're seeing here, though, is he's saying, you have this declining rates, and an analyst or, an equity investor could actually buy something, leverage up on cheap debt, especially if that debt keeps coming down. All of a sudden, you have levered up that return from what you thought was going to be 8% to 25%. Now, he goes on to say, it seems to me that a significant portion of all the money investors made over the period resulted from the tailwind generated by the massive drop in interest rates. I consider it nearly impossible to overstate the influence of declining rates over the last 4 decades. And again, it's kind of going back to what he had mentioned earlier about how important it is that rates did decline, and people who probably thought they were genius were probably genius because they were born and investing during a time when there's declining rates. Now, he mentions for what it feels like eons from October 2012 to February 2020, my standard presentation was titled Investing in a Low Return World because that's what our circumstances were. With their prospective returns on many asset classes, especially credit, at an all-time low, I enumerated the principal options available to investors. Invest as you previously have and accept that your returns will be lower than they used to be. Reduce risk to prepare for a market correction and accept a return that is lower still. Go to cash and earn a return of 0, hoping the market will decline and thus offering higher returns, or ramp up your risk in pursuit of higher returns. I think we know what people chose on these principles. Each of these choices have serious flaws, and there's good reason for that. By definition, it's hard to achieve good returns dependably and safely in a low return world. He goes to talk on how, inflation worsened as 2021 wore on, and late in the year, Fed acknowledged that it wasn't likely to be short-lived. Thus, Fed started reducing purchases of bonds in November, began raising interest rates in March 2022, kicking off one of the highest rate hiking cycles on record. And he said, kind of jumping down, as I wrote in the memo, on the couch, whereas the events in the real world fluctuate between pretty good and not so hot, investor sentiment often careens from flawless to hopeless as events that were previously viewed as benign come to interpret it as catastrophic. Higher interest rates led to higher demanded returns. Thus, stocks that had been seemed fairly valued when interest rates were minimal fell to lower PE ratios that were commensurate with higher rates. Likewise, the massive increase in interest rates has had its usual depressing effect on bond prices. Falling stock and bond prices caused FOMO to dry up and fear of loss to replace it. The market's decline gathered steam, and things that had done best in 2020, 2021 now did worse, further dampening psychology. Exogenous events had the ability to undercut the market's mood, especially in tougher times. In 2022, the biggest such event was Russia's invasion of Ukraine. The Ukraine conflict had reduced supplies of grain and oil and gas, adding to the inflationary pressures. Since the tighter monetary policies were designed to slow the economy, investors focused on the difficulty the Fed would likely have achieving a soft landing, thus the strong likelihood of a recession. The anticipated effect of that recession on earnings dampened investor spirits, thus the fall of the S&P 500 over the 9 months of 2022 rivaled the greatest full-year declines of the last full century. The expectations of a recession also increased the fear of rising debt defaults. New security issuance became difficult. Having committed to fund buyouts in a low interest rate environment, banks found themselves with billions of dollars of hung bridge loans unsaleable at par. These loans have saddled the bank with big losses. These hung loans forced banks to reduce the amounts they could commit to new deals, making it harder for buyers to finance acquisitions. Now, the thing that he had added into this was actually this table that you see here. So he's comparing sort of this 2009 to 2021 what people believed, the sort of attitudes people had, and then what we see today. So 2009 to 2021, the Fed behavior highly stimulative. Again, low rates, buying back their own debt, basically. Really low rates. Actually, they really tried raising rates in 2018, 2019. It didn't work at all. People got really mad, and Wall Street got really mad. Inflation's been almost non-existent. We were talking about deflation not too long ago. Economic outlook, people are thinking it's going to be a recession. It probably will end up being a recession of some magnitude. Likelihood of distress, they're thinking it's going to continue to rise. Mood is guarded. Buyers are hesitant. Holders are uncertain. Key worries, investment losses. Risk aversion is rising. Credit windows constricted. And then financing is scarce. Interest rates are more normal. Yield spreads are more normal. Prospective returns more than ample. So this is that whole what he is mentioning, and really the belief set going into today, what it actually looks like, and the opportunity. So you're thinking, okay, why do they believe that, some of these more behavioral things, they're more guarded when prices are falling, but during a huge bull market, they're more and more eager, especially as you kind of got into 2020, into 2021, that was some crazy FOMO and some crazy eagerness to make more and more returns. And I think people kind of, your mindset should be different today than it is on this left side. It should be different on the right side. These should almost be flipped, at least on the how people emotionally react. Fed behavior and things like that. they're going to do whatever they're going to do. But how you view the market and your worries and things like that really do matter. And I think that controlling your emotions in this entire time is probably the most important thing you can do. So he said in the right-hand column accurately describes the new environment as I believe it does. Then we're witnessing a complete reversal of the conditions in the middle column, which prevailed in 2021 and late 2020 throughout the 2009-2018 period and for much more of the last 40 years. How has this change manifested itself in the investment options? Here's one example. In the low return world of just 1 year ago, high yield bonds offered yields of 4 to 5%. A lot of issuance was at yields in the threes, and at least one new bond came to the market with a handle of 2. The usefulness of these bonds for institutions needing returns of 6 to 7% was quite limited. Today, these securities yield roughly 8%, meaning after allowing for some defaults, they're likely to deliver equity-like returns sourced from contractual cash flows on public securities. Credit instruments of all kinds are potentially poised to deliver performance that can help investors accomplish their goals. Now, again, the whole expectation of investing in something like an S&P 500 fund is 8 to 10%. If bonds are getting 8 to 10% yields, that means that companies and stocks have to come down even more because bonds are considered, in some cases, not every case, but the safer bonds are considered safe. Obviously, as you get down the credit rating, it expands, but the stocks and things like that also are going to drop because people are able to transition money from riskier and riskier stocks to safer bonds and likely get the same return at a more stable year-over-year basis. Now, here's his outlook, or just, I guess, outlook in general for him. He said, while I know everyone thinks, or how little I think of macro forecasts, a number of clients have asked me recently about my views regarding the future of interest rates. Thus, I'll provide a brief overview. Oaktree's investment philosophy does not prohibit having opinions, just acting as if they are right. In my view, the buyer who's driven the S&P 500 recent 10% rally from October low has been motivated by their beliefs that inflation is easing, the Fed will soon pivot from restrictive policy back towards stimulative, interest rates will return to lower levels, a recession will be averted or will be modest and brief, the economy markets will return to halcyon days. I'm not pronouncing that right at all. He said, in contrast, here's what I think. The underlying cause of today's inflation will probably abate as relief-swollen savings are spent and as supply catches up with demand. While some recent inflation readings have been encouraging in this regard, the labor market is still very tight. Wages are rising and the economy is growing strongly. Globalization is slowing or reversing. If this trend continues, we'll lose its significant deflationary influence. Importantly, consumer durables prices declined by 40% over the years 1995 to 2020. Importantly, consumer durables prices declined 40% over the years 1995 to 2020. No doubt thanks to less expensive imports. I estimate that this took 0.6% per year off the rate of inflation. Before declaring the victory on inflation, the Fed will need to be convinced that not only that inflation has settled near the 2% target, but also that inflationary psychology has been extinguished. To accomplish this, the Fed will likely want to see a positive real Fed funds rate. At present, it's minus 2.2%. Thus, while the Fed appears likely to slow the pace of its interest rate increases, it's unlikely to return to stimulative policies anytime soon. The Fed has maintained credibility or regain it after having claimed for too long that inflation was transitory. It can appear to be inconstant by becoming stimulative too soon after having turned restrictive. The Fed faces the question of what to do about its balance sheet, which grew from $4 trillion to almost $9 trillion due to its purchases of bonds. Allowing its holding of bonds to mature and roll off would withdraw significant liquidity from the economy, restricting growth. Rather than be in stimulative posture on a perpetual basis, one might imagine the Fed would prefer to normally maintain a neutral interest rate, which is defined as neither stimulative nor restrictive. I know I would. Most recently, last summer, that rate was estimated at 2.5%. Similarly, although most of us believe this free market is the best allocator of economic resources, we haven't had a free market in money for well over a decade. The Fed might prefer to reduce its role in capital allocation by being less active in controlling rates and holding mortgage bonds. There must be risks associated with the Fed keeping interest rates stimulative on a long-term basis. Arguably, we've been seeing most recently that doing so can bring on inflation. The inflation of the last 2 years can be attributed largely to the one-off events related to the pandemic. The Fed would probably like to see normal interest rates high enough to provide it with room to cut if needed to stimulate the economy in the future. People who came into business world after 2008 or veteran investors with short memories might think of today's interest rates as elevated, but they're not in the longer sweep of history, meaning there's no obvious reason why they should be lower. These are the reasons why I believe that the base interest rates over the next several years is more likely to average 2 to 4%. And it basically ends there, and kind of, the rest of it was just touching on what he believes in, the returns of the world and what he can see going forward. But really, the important overarching thing about all of this is that we went from, kind of the Paul Volcker days of having no interest and then having to raise interest, get rid of inflation. That caused from there lower and lower interest rates that have been near zero or at zero for the last decade or so, especially as in the most recent years. And then now we're having another change where we may actually see some federal interest rates stay as we kind of see things start to normalize and inflation rates start to normalize, or try to normalize them at the very least. And if the Fed doesn't see any sort of changes moving forward because of this interest rate increase, we'll see either them hold rates or continue to increase rates at an incremental pace. Now, they don't think that they're going to cut rates in 2023, but we'll have to see in general what that's all going to look like. Because right now, cutting rates is sort of a tool for the Fed, but if they keep rates at near zero, that's not going to be a tool that's going to be able to be used. So you really want to be careful with how low you cut rates and if you keep them there like that. So it'll be interesting to see, though. Let me know what you think about this memo in general down in the comments below. I love listening to Howard Marks. I love reading his memos. I think he has a lot of good insight, and I definitely learned a lot from this. But let me know what y'all think down below in the comments. Hope y'all stay tuned. I hope to show you another one of these videos. If you liked it, make sure to subscribe. Have a great day and happy investing.